It drives me crazy when people mix up index funds, mutual funds, and ETFs. So in this video, I'm gonna break this down and erase all confusion. Okay, so to be fair, there is a little bit reason for confusion because you have financial gurus and influencers everywhere telling you index, 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 buy this index fund, do this, do that. But at the end of the day, it's hard if you are somewhat knowledgeable about something but not fully confident, because you can still find yourself not making an investment decision. And there is some overlap in all of this. So I'm going to break all of this down, and just don't worry, you'll figure it out. If you're new here, my name is Maoli Vodi with Financially Present. I used to be a stockbroker. Now I just focus on educating people on the stock market and anything investment related. So if you're new to the channel, I want you to hit that like button, subscribe, and turn on notifications so you don't miss out on future content. Okay, so the bottom line is an index fund can be a mutual fund, but it also could be an ETF. But in order to walk through this, we're going to start with a mutual fund, talk about index funds, and then wrap it up with ETFs. Okay, so with that said, a mutual fund is a professionally managed fund with a group of assets within this fund. So the fund manager, they essentially have stocks, bonds, it could be commodities, all types of assets, all within this fund. And now they are packaging it up and selling it to a group of investors. These investors don't have to know each other. They don't have to talk at all. All they know is that they are mutually invested in this fund. So what you see when you're looking at a mutual fund price is not the same price you would see with a stock price. It's the net asset value. So all the assets that are managed within the fund, they have now subtracted any cost associated with this, and then they divide it up into shares. And that's the price you're seeing. It's the net asset value. So when you think of a mutual fund, I want you to consider it as an investment company. In fact, that's why it's under the Investment Company Act of 1940. You see, the mutual fund manager is, in fact, managing this company. And in order for them to calculate the value, they need to wait for the stock market to close, the bond market to close, the commodities market. All of that has to close in order for them to calculate the value. So mutual funds only trade once a day. So that, along with some other unique characteristics that follow, because they're not a standard investment like a stock would be. They are a hybridized investment. For most accounts that you have, you can actually set it up to automatically deposit some money into the account and then automatically purchase mutual fund shares. And if you wanted to reinvest, it will reinvest any dividends that are paid out monthly into purchasing more of that mutual fund. And if you prefer to get the cash, you can have it pay out the cash. But mutual funds come with a lot of conveniences, and then there's some other not so convenient things about them. Mainly, the benefit of having a mutual fund is that they are just convenient. You don't have to do all of the research. You just find a professional that does it because it's professionally managed. And it's naturally diverse because most mutual funds are going to have 40 or more investments within it. In fact, most of them have hundreds of stocks and other investments within the fund. And all you have to do is buy that fund in particular. Some of the downsides of mutual funds is that they are long-term only. So if you're a short-term investor, a mutual fund is not really going to be something that you're interested in. You could even be penalized if you try to invest in a mutual fund and you change your mind a few days later. You know, they don't want people jumping in and jumping out. They want this to last as long as possible. So they will continue to add more assets as they get more and more investors. That's how most mutual funds are designed. Another inconvenient thing is the fees are generally higher because they are actively managed. So remember, the professional fund manager, they're doing their best to increase the value of this fund. They want to make sure that they're beating benchmarks and beating indexes. So they might be making some decisions, and some of those decisions could backfire. So regardless, you have to pay a fee. There is an expense ratio for every mutual fund out there, and they could be as high as 2 or 3%. So think about it. If you have $10,000 managed in a mutual fund and they're charging you about 3%, each year you're paying about $300 on that, whether you make money or lose money. The fee is in relation to how much you have managed there with that mutual fund. So that brings us to index funds. So in 1976, a guy named Jack Bogle, he pioneered investing by creating the index fund. And he started with the S&P 500 because he saw that indexes do very well. Sometimes they even beat actively managed mutual funds. So this new index fund, this S&P 500 index fund, simply followed the S&P 500 index. And if you aren't familiar with indexes, they are just snapshots of the stock market. They're a grouping of stocks that are the representation of the stock market. So think about the Dow Jones Industrial Average. So those are 30 stocks, or the S&P 500, or the NASDAQ 100, Russell 2000, Wilshire 5000. These are all different indexes, and they are a representation of the market. So he figured, create a fund that is not trying to do anything fancy, just simply follow the index, and that's all it's doing. So this type of index fund did very, very well. And that's because the S&P 500 did well. So you started to see other people copy this. And then eventually, this leads us to an ETF. So an ETF, or exchange traded fund, hit the scene in 1993. And essentially, it followed the S&P 500 index. So this exchange traded fund has a lot of the characteristics of a mutual fund, but it is doing everything that a stock would. So it trades on an exchange just like a stock would. You can buy and sell it in the same day, or you can buy and hold it for years and years to come. So it has a little bit more flexibility than a mutual fund, and the fees are as low, if not lower. So you have a passively managed, diverse, comprehensive fund that's tracking an index, and the fees are really low. So now that creates this different level of convenience of trading. So there are some people where if you couldn't meet the mutual fund minimum, you could find an ETF that allows you to just buy one share, because there aren't really minimums for an ETF. It's more of, if you can afford a share, you can buy it. So starting from that one ETF in 1993, it has exploded. There are thousands and thousands of ETFs now in 2024, and some are passively managed because they're more of index funds, or they follow a specific objective and they don't try to change much. And then there's also actively managed ETFs where they're packaged up and you can buy them on the stock market like a regular stock, but there is a professional fund manager that's making some decisions. So think of different funds like ARK ETF by Cathie Wood. There are different actively managed ETFs that are out there. Here are a couple S&P 500 mutual funds, and then here are some S&P 500 ETFs. Feel free to take a look at them, look at their fees, and look at their performance. The performance should essentially be the same. The difference would be the expense ratio. So make sure that when you're investing, you do your research, and then you buy what's comfortable for your portfolio. So just to recap, the mutual fund came first, then the index mutual fund came along, and then eventually an ETF, starting from an index, exploded and it changed the entire industry from there. What type of index funds are you using in your portfolio? I'd love to know in the comments below. And until next time, stay present.